So very recently, I was at a family member's funeral, and while this is unpleasant, it is an inescapable part of life. And while I was watching the funeral director go about their business, it really got me thinking about the business of being in the funeral service industry. Now, this is not something that I would ever want to do myself, but it is something that is very necessary because unless you're going to live off the grid and avoid paying taxes, you still will not be able to escape your expiration date. So I found a few companies that look like they could be interesting investments that I would like to put on your radar and introduce you to, and they also happen to each pay a dividend. So before we get into it, like any industry, there's always shifting trends, and one in this industry is that, check it out, in 1960, only 3.6% of Americans chose cremation. But according to the National Funeral Directors Association, in 2021, 57% of the U.S. population chose cremation over burial, and by 2040 they expect 78% to choose cremation over traditional burial services. And that's because cremation is cheaper, it's greener, and there's quite a few less religious prohibitions than there have been in the past. So stick around at the end because I'm going to give you my thoughts on the matter, and I'm going to give you a very, very surprising fact. And as we look at these, we're going to use Simply Safe Dividends and Alpha Spread, and particularly when we're on Simply Safe Dividends, we're going to go pretty quickly, and remember that you can pause the video, zoom in, and look at these numbers if you would like to a little bit more in depth, because they do show 10 years on a nice, clean, and smooth and concise graph. Or is it a chart? So at number 3, I have for you Carriage Services, ticker CSV on the stock market, which was founded in 1991. They have about 173 funeral homes, 32 cemeteries, and have had an 11.5% earnings per share growth since 2013. And because they're smaller, they can easily buy up smaller funeral homes, which can boost their profits. So Carriage Services is a micro cap, only $387 million, but they do pay a 1.81% dividend. And they have had some pretty nice dividend growth, 15% 5-year CAGR, and the last full year increase was 9%, to where it's been frozen at 45 cents per share annually, but a super duper free cash flow payout ratio of 14% the last 12 months. $3.29 of free cash flow per share can easily cover that dividend of 45 cents. Now, a lot of these have that theme recurring in 2020 and 2021 because of COVID. They got a boost to their sales, so they've had a bit of a drop off. But even for a microcap company, on the whole, they're still buying back shares down to currently 15.4 million shares outstanding, and their total sales keep going up and to the right. Margins aren't too bad. You'd like to see some of these a little bit higher, but for what they do, really not bad. Net debt kind of high at 80%, and that interest coverage ratio only $2.45 the last 12 months. Would like to see a little bit more wiggle room on that. Alpha Spread gives them an intrinsic valuation on the base case. Remember, this is just their guesstimate. It's just a nice reference point of $44, so meaning it could be about 44% undervalued, and on the worst case, about 29% undervalued. And we'll also be looking at the ownership. This is the insiders, so no recent buys, and overall there's been 181 sales but more purchases than buys, so 201 purchases. That's kind of nice, but their CEO Melvin Payne looks to have sold some shares in June of 2023. Number 2, Matthews International, ticker MATW. Now they do have 3 segments, but it is the middle one here, the memorialization, that we're going to focus on, because that has to deal with providing memorialization products for the funeral industry, including things like memorials, caskets, and cremation equipment. Now, about half of their revenue comes from their memorialization business, where they have a strong market share. They're the second largest provider of caskets, and most of their sales are in the United States and Canada. And what's pretty neat is that Matthews is like a one-stop shop for funeral homes. Plus, they benefit from the growing trend of cremation, which is cheaper than traditional burials, as we talked about, so they're going to make money either way. Now, Matthews International is rated on Simply Safe Dividends 74. They give a safe score. $124 billion small cap company. Now, Matthews was founded in 1850. Their dividend growth, pretty good. Look at that, a 29-year dividend growth streak, 5% 5-year CAGR. 11% 20-year CAGR, but only a 4.5% dividend increase last time around. Currently giving you 92 cents per share every year, which breaks down to 23 cents a quarter, but it looks like as of this recording, they are about ready for another dividend increase, probably going to be about a penny. Their dividend yield is currently 6% below the 5-year average of 2.48%. That PE is a little bit high, and their price is actually toward the higher end of their 52-week range. But what's Matthews got going on here in the free cash flow payout ratio? 46% last 12 months, so that's still low, but it's still way, way above where they have been traditionally over the last 10 years. But that $2 in free cash can easily cover the dividend. The EPS growth is a little bit like a roller coaster, down, up, and expected to be up in the next 12 months. Now, overall, they've pretty much been buying back shares down to 30.8 million. Their total sales is a little bit rocky, but still up and to the right. Now, their profitability margins could be a lot better. Only a 3% return on invested capital. Not very good operating and free cash flow margins. Net debt, little bit high at 62% for my liking, and a very, very, very worrisome and low interest coverage ratio, 1.11%. So with interest rates increasing, we'd need to look at when some of their debt is coming due, when it's maturing, and see if they're going to be able to ride out this rate period of higher for longer. And good old alpha spread gives them an intrinsic value of $43 on the base, meaning about 8% undervalued, and $32 on the worst, so about 18% overvalued. And as for ownership, we actually got some buying going on here with the director, Aletta W. Richards, picking up a cool 1,090 shares on August 9th, but overall 208 sales to only 25 purchases. And in the number one spot, we have Service Corporation International, ticker SCI. They are the biggest player in the funeral business. They own over 1,900 locations in 45 U.S. states, Puerto Rico, and Canada. SCI is the largest U.S. provider of cremation services. And check this out, they even have a business called Neptune Reef, where they blend cremated remains with a natural concrete substance, which is then molded and secured within the various artistic structures, complete with an engraved copper plaque. SCI has also been buying up other funeral businesses to streamline this fragmented funeral business industry, where they do control about 15% of the market. And after a boost due to COVID, they are looking at a steady earnings per share growth of about 8 to 12% annually. So Service Corporation International does have a dividend safety score of 76, current yield 2.16%, 8.3 billion. So they are indeed the biggest of the three we've looked at and the biggest in the industry. They were founded in 1962, 12% 5-year CAGR, 16% 10-year CAGR. So they've been growing that dividend pretty quickly. 12-year growth streak, 17 years uninterrupted dividends. Currently paying $1.16 per share, and they do increase that pretty quickly. Here they've raised it a few times in a year. So last raised up to 29 cents per quarter, $1.16 per share. That yield is 36% above the 5-year average of 1.59. That PE is way below the 5-year average, so looking like it could be a buy here. Their 52-week price range buried at the low end. Free cash flow payout ratio of 51%, but expected to be 34% next 12 months. Again, that $2.10 of free cash can easily cover the dividend. They had that big boost in 20 and 2021, but sales have fallen off a little bit. Shares outstanding really nicely down and to the right. Like to see that. Total sales going up and to the right, although it was a little bit slow going there in the mid-teens. Profitability margins are not too shabby. Free cash flow margin, would love to see that back into the upper to mid-teens. 73% net, quite a bit of debt, and a $4.06 interest coverage ratio. Remember, that means they have $4.06 of operating income to cover every $1 of interest expense on that debt. Current intrinsic value of $64.66 on alpha spread, about 18% undervalued. Worst case, $55, so about 4% undervalued at the recording price right now. And like a lot of big companies, there's just been no buying going on, which I don't get. You'd like to see them buying when the stock seems like it's kind of cheap. They've had 404 total sales and 49 purchases, and it looks like their CEO, Thomas Ryan, all the guy does is receive shares and sell shares. Hey, that's his MO. Probably a lot of stock options in there. Now, if I had to choose one of these, I would go with Service Corporation International, just because they're the biggest and they look to have that nice growing dividend, which is what we look for in dividend growth stocks. Now, personally, when my time comes, what I want to do, I'm actually still undecided. I am a Navy veteran, so I am eligible to have a burial at sea. So here's that fun fact I had for you. In about 5 billion years, our sun is going to turn into a red giant and eventually incinerate and cremate the entire planet. So either way, it looks like we're all going to be in line for that cremation service, compliments of the sun. So I may just go with the cheaper route because, hey, we're all about fire here, and what begins with fire may very well end with fire. Well, this was a fun episode, wasn't it? For something a little bit lighter and maybe a little bit tastier, check out this live stream I did right here, where in the very beginning, I talk about PepsiCo and their dividend and why I think the share price of PepsiCo has been plummeting and a few issues that I may be encountering with them. Take a peek at it, and if you do that, I will talk to you there.